Hi friends, welcome to my channel. This is your Govindraj. Today we are going to talk about an important topic about your Provident Fund and retirement savings. And basically in the recent past, especially in 2020 and 2021, there were two important changes have been brought by the Finance Act 2020 and Finance Act 2021, and you must have already read and heard about this in the media and also very much in social media. And especially the Finance Act 2020 and 2021 have brought certain changes which are basically aimed at taxing certain savings, and more particularly your retirement savings of employees contributed by employees and also employers both. And the first one is, if your employer is contributing to various retirement funds like employees provident fund, national pension scheme and approved superannuation fund, such contributions are taxable if it exceeds rupees 7.5 lakhs in a financial year. This is the first change which is brought by Finance Act of 2020. And the second one is, the interest accrued on your provident fund accumulation is taxable provided it exceeds certain limits, and that is effective from 1st April 2021. So this we are going to talk about it in detail also. And as I said, the first one is introduced in Finance Act of 2020 and the second one was introduced in Finance Act of 2021. And as I said, we will talk about all these changes and also their impact on your income and also responsibilities of the employer. What are these things and what employer has to do and what special precautions you have to take care. All these things we are going to discuss. And before we get into this main topic, as usual, you know my style, I will not get into the topic unless I give you certain background. So therefore, let's connect the dots on these provisions and also try to understand more about it. So in by understanding certain background prior to it. Now, before I get into it, friends, you have to understand what is this Finance Act. See, basically, every year you will have one Finance Act which is introduced during the budget, and this is actually a fiscal legislation that gives effect to the financial proposals of the central government. And during the budget, the government proposes various measures and also of course provide certain relief. So therefore it is necessary to give effect to all these measures and also the provisions. And these Finance Act measures and provisions can also amend the connected legislations. It could be Income Tax Act, laws related to GST and of course many more. So this is basically about the Finance Act, and if you don't know about this, then definitely you will be wondering what is this Finance Act. So therefore I just gave you a brief. Now, before getting to these changes brought in Finance Act 2020 and 2021, so we need to know what are the current exceptions or exemptions available for EPF, Employees Provident Fund, which is basically, and the contributions for National Pension Scheme and also approved superannuation fund from the income tax net. And if you look at this Employees Provident Fund contributions, these have been enjoying almost fully exempt status. See, we call it as exempt. So this means the contributions are exempt at the time of making contributions, and the running fund balance and interest on accumulation, and also exempt at the time of withdrawal. Of course, there are certain conditions also there are put forth in the act. EPF contributions withdrawn before completing 5 years and interest in excess of government notified rate, or employer contribution in excess of specified limits are still taxable because of the 4th schedule rule 8. And barring that, the EPF contributions largely enjoy this exempt status. And coming back to national pension scheme and approved superannuation contributions, these are also have been enjoying partial exempt status. We call it as exempt tax. So this means these are exempt at the time of contribution, and running fund balance is exempt, interest on accumulations, but they are partially taxable at the time of withdrawal. In the case of approved superannuation fund, one third of the commuted value of pension on your retirement is exempt, but of course the pension what you get is taxable. And if you look at the national pension scheme contribution, these are at the retirement stage. Withdrawal of 60% corpus is exempt, but another 40% there is a mandatory condition that this 40% fund you have to use it to buy annuity plans or pension plans. And this status has been basically altered by the Finance Act of 2020 and 2021. Because of these changes, this made certain components are taxable, basically these NPS and EPF contributions, everything. So now let's understand what are these changes and how these are going to impact your retirement savings, especially the provident fund and related savings. Now, before we get into the 2021, let's understand what is the change brought in the Finance Act 2020, which actually impact your provident fund accumulations and also savings. See, if you look at this Finance Act 2020, it substituted subclass 7 of class 2 of section 17. This section 17 basically explains what is salary and perquisite and profits in lieu of salary for the purpose of income tax. And particularly if you look at class 2 of section 17, this explains what all includes as a perquisite which forms part of taxable income in the hands of employee. And as per this substitution which was made in Finance Act 2020, the employer contribution, especially note this, the employer contribution to a recognized provident fund and also to approved superannuation fund, you can shortly call it as ASF, and of course the contribution to national pension scheme or contribution to pension scheme of any central government allowed under section 80 CCD in excess of rupees 7.5 lakhs, and of course on this excess whatever accretions happens or whatever increase happens by way of interest or dividend on such excess, this becomes taxable in the hands of employee from 1st April 2020. And this is the first impact and change which brought by way of Finance Act 2020 by substituting this subclass 7 of class 2 of section 17 of Income Tax Act 1961. And we will handle this part in a separate video, because if you are going to club with this the changes in the Finance Act 2021, it will become very complicated and will be difficult to handle it. So therefore let's handle the changes brought in Finance Act 2021, especially it is related to your provident fund contributions and especially made by the employee. So therefore the first part with the changes which is brought from Finance Act of 2020, we will handle it in a separate video. And now we are going to handle the changes which are brought in Finance Act of 2021, especially on the contributions of employee made to provident fund. So now, what is this change which is brought in Finance Act 2021? Of course, this is going to impact your provident fund accumulation. See, especially Section 10 of the Income Tax Act 1961 lists all income which are not included in the income for the purpose of taxation. So in this Section 10, there are many income components which are not included for the purpose of taxation, which includes agricultural income and other incomes. And the accumulated balance, and when such balance becomes payable from any recognized provident fund, which includes employees provident fund also, is listed under section 1012, that means subsection 12 of section 10, as not an income for this purpose to the extent allowed under rule 8 of part A of the 4th schedule. This basically, this 4th schedule of Income Tax Act, especially part A, lists out certain provisions related to recognized provident fund. And as per rule 8 of this schedule, the provident fund accumulations including interest are protected from the income tax. Of course, there are certain limits and conditions which also we need to know. That limits are if any employee is going to withdraw the provident fund and also the interest after completion of a continuous period of 5-year service, then it is protected from the income tax net. And of course, if services are terminated because of ill health and also because of the employer discontinuation of businesses beyond the control of employer, in such case the 5 years condition is not required. He can very well withdraw the provident fund without any income tax net. This is also possible when he leaves the one company and joins another company. In such case, these accumulations can be transferred to the new employer account or the EPF account which is provided to him. In that case also, without adhering to these 5-year service conditions, those accumulations are protected. Now we have to understand what is this change is brought in Finance Act of 2021. See, especially in Finance Act of 2021, two important provisions were inserted to section 1012, that is subsection 12 of section 10 of Income Tax Act 1961. These are basically inserted to exclude certain payments from the Provident Fund from the exclusions already available under this section. And of course, this will take effect in the financial year of 2021, that is, which is assessment year 2022 and 23, and these are effective from 1st April 2021. Now let's look at these insertions and also the impact which is going to happen on your retirement contributions and this provident fund especially. And if you look at the first proviso, this basically provides for interest accrued on employee contribution in excess of rupees 2.5 lakhs is treated as income in the hands of the employee for the purpose of income tax. You have to note that accrued on employee contribution. So the employer contribution, this section is not talking about, and this means the interest on the employee contribution over and above 2.5 lakhs or which exceeds 2.5 lakhs made during financial year 2021 and 22 to be treated as income in the hands of the employee, and of course this is going to continue in the subsequent financial year also. So this is the first proviso where the interest which is beyond the employee contributions of 2.5 lakhs, that becomes taxable in the hands of employee. Now there is another proviso which is added, the second proviso. This is inserted to provide some relief to the employees where there is only employee contribution and not from the employer contribution. See, in such cases this ceiling is enhanced to 5 lakhs. So this means the interest on contributions in excess of 5 lakhs in the previous year gets into the category of taxable income. So this relief will not apply to the members of employees provident fund because there is a mandatory contributions from the employer for the EPF. So therefore this proviso could benefit employees who contribute to public provident funds and other recognized provident funds. Now how the interest has to be compounded and also how these accounts have to be maintained are required to be prescribed by the central government, and rules on this are now notified by the central government, which you must have recently seen, especially on 31st of August 2021, and rule 9C is inserted into income tax rules 1962 to give effect to the provisos, first proviso of section 1012, so which is basically this proviso was inserted by Finance Act of 2021. And the story is, because of these changes and the rules, the story is the provident fund accumulations and interest earned for the period before 1st April 2021 are protected from the income tax net. So whatever you have accumulations from before 31st March 2021, so they are not going to be touched from the income tax point of view. The Provident Fund Authority or this EPFO will have to maintain two accounts hereafter, because one is the non-taxable contribution account, which will comprise provident fund accumulations and interest, which is not part of income tax, and the second account is taxable contribution account, which will comprise the contribution in excess of threshold limit, that is which is 2.5 lakhs where the employer contribution is involved, and 5 lakhs where there is no employer contribution involved, and also interest on such excess contributions for the financial year 2021 and 22 and for all subsequent years. So the EPFO is going to maintain two accounts. One is non-taxable contribution account, the other one is taxable contribution account based on these ceilings. Another important provision in this case you have to note down is the tax on the interest attracts the provisions of section 194A of Income Tax Act 1961, and therefore the Provident Fund Authority or the EPFO has to deduct TDS if the interest exceeds the limit specified, of course, which is currently 5,000 rupees, and of course at the specified rate. Now the rate is 10%, and this rate of tax which is deducted on the interest can be more if the permanent account number is not added into the EPFO account by the employee. And of course the EPFO issues a TDS certificate in such cases, and the employee concerned is required to treat the interest as taxable income, and any difference tax based on the slab which is applicable is to be paid or borne by the such employee while he submits his return. So these are the overall changes which are brought from the Finance Act of 2021, especially this is if you are in the higher income group and your contributions are more than 2.5 lakhs, and whatever in excess of 2.5 lakhs, the interest which gets earned which is declared by the Provident Fund Authority, so that interest becomes the part of income tax net. So therefore you have to be very careful, and also especially as I said, this is also going to be applicable more and more for higher income tax bracket people, and they have to be very careful, and the employer is also required to the employer is also required to advise his employees properly. Now let's take an example. So we have talked about it, basically the EPF accumulations and interests as of 31st of March 2021, these are protected. Say for example it is 7.5 lakhs, so those accumulations are not to be worried, and they are safe from the tax part of it, and no action is required. And from 2021 April onwards, suppose you assume that your monthly contribution on a basic salary of 2.5 lakhs at 12% works out to 30,000, and that gets, if you multiply into 12 months, you have 3,60,000 rupees. And this 3,60,000 rupees, now the threshold you know that 2.5 lakhs, and the difference between 3,60,000 and 2.5 lakhs, of course this is 1,10,000, and the interest on 1,10,000 will become the taxable income in the hands of employee. So this have to be very careful, and also you have to understand this. And of course the next question comes to your mind is that what is the rate of interest which Employees Provident Fund Organization declares? Well, this you are already aware, every year the EPFO declares a certain interest and also credits to the Provident Fund, and only the mandate now for the EPFO is to update this interest well in advance, so that the taxable interest can be derived, and also it should the EPFO should issue the TDS certificate before the deadlines, so that the employee can file the returns within the timelines of income tax return submission. So friends, the conclusion is that this change largely affects the high income employees, and therefore such employees may look for changes in their salary structure. Of course, if they are looking for a salary restructure, it may not be advisable if the employer is contributing equal contributions based on his full basic salary, so that may not be advisable. However, if such employees are contributing by way of voluntary provident fund, so that can be decided to stop to the extent which is increasing this threshold. So in this video basically we talked about a certain brief on Finance Act 2020, the changes which are brought basically on this retirement savings, and also the changes which are brought in Finance Act of 2021 and how they are going to affect. Of course, in the next video we are going to talk about these changes in which are brought in Finance Act 2020 and their impact. Until then, I will take a leave from all of you, and we will see you in the new video with the new information. And if you feel this information and this video is has added to your knowledge and you got benefit out of it, I would request you to share this video to all your contacts, and also don't forget to like and also comments in the comment section of this YouTube channel. And if you have not subscribed to the channel, please do subscribe so that you get regular updates on various matters of labor law and labor relations, and also this certain tax part of it, which are related to, basically which are connected to the labor laws. And thank you very much, and see you soon, friends.